Good morning and welcome to Armanino McKenna's Revenue Recognition webinar. We're going to review the proposed International Accounting Standard Board and FASB Revenue Standard. So I want to remind everybody that this is a CPE webinar, and in order to qualify for CPE, we're going to be asking you polling questions throughout the presentation. You need to answer 75% of those polling questions, as well as be on this call for 50 minutes or more. My name is Lori Colvin, and I'm going to be your moderator for the day, and we really welcome you and thank you for coming. First, we want to go over a few housekeeping items. Your webinar pane that you're seeing now, you can ask questions throughout this presentation, and at the end of the presentation, we will answer them. You can also minimize and maximize your window simply by touching the red arrow, as well as the little box to make it big again. And so we can make sure that you're all hearing us correctly. If you are listening through the telephone, be sure that you've marked use telephone. But if your audio is streaming through your computer, be sure that you mark use mic and speakers so you get a clear audio performance. It's my pleasure to introduce to you our two presenters. First, I'd like to introduce to you Matt Peralt, who is a partner here at Armanino McKenna in the audit practice. He leads actually the technology and SEC practice for us. He is a recognized subject matter expert in revenue recognition and frequently consults with his clients on that area. Also, he's been in private industry and helped with numerous IPOs and mergers and acquisitions, so he really comes to you with a great background of kind of being in the trenches as well as in public accounting. And he is going to review all the upcoming revenue standards. Then I'm also very pleased to present to you Yolong King, who is a manager in our consulting department. And she's going to talk to you about some of the real solutions that is happening in software to help with revenue recognition. She is a consultant in that area and works with just a ton of clients on that issue, as well as she too has been in private industry, so has kind of seen it from both sides of the fence. Next, we are going to go over what are you going to learn today. Today, we're going to first start with reviewing the proposed new revenue standards. We're going to discuss a timeline for adoption, which is really good for you to know for planning purposes. We're going to look at really some of the top issues that companies struggle with revenue recognition and dive into some of those system solutions and how you automate the process so that you can walk away today kind of understanding the future and seeing kind of a path to solution for some of these issues you deal with. The overview of the presentation today is really looking at the proposed new standards and walking through the specific rules for recognizing revenue under the new standard, and then again walking through the solutions and the automation process. Then we're going to kind of transition into some of the new disclosure rules for the standard. So I am going to turn you over to Matt Peralt, and he can begin the presentation.
Thank you, Lori. So it is a single new standard, and for those of you that like to memorize numbers, the FASB is going to issue this under ASC code 605. So that's going to replace what is currently in the code under 605. So a little background about the project. This is a joint project between the FASB and the IASB. It's intended to be a single model that replaces a huge body of existing revenue standards. If you think about it, everything from software revenue recognition under 97.2, construction, real estate franchisers. It is being put out with an intent to simplify and remove inconsistencies and provide users with more meaningful information. Hopefully it's going to improve the comparability across entities, jurisdictions, and capital markets. And right now the standard is in the feedback phase where the FASB is seeking feedback from its constituents. So here's the timeline. This revenue project was kicked off in 2008. You can understand the scope of the revenue project and why we're now into year 3 of this. there is more than 1,000 pages of existing revenue guidance and interpretation between the FASB rules and the SEC rules. If you look at the new standard, it is in its simplest form 31 pages of rules, followed by about 40 pages of implementation, guidance, and examples. And there's about 100 pages of background, and then 200 pages, which really just shows you how that overlays into the existing codification. So it's a pretty large body of work, and again, this is one of the first attempts by both the FASB and the IASB to get together and say, how can we develop a standard that meets the needs of both U.S. and international constituents? And one thing that is missing from this slide is that even in January of this year, 2012, they did issue a further amendment to the standard to add some clarification to this. The expectation is that the final standard is going to be issued sometime in 2012. As I said, the comment period is still open until March of this year. So the FASB is seeking comments and hopes to get those in by March. And what's interesting again about this standard, I think just because of the breadth of it, the normal path is that the FASB will issue a exposure draft, they'll get comments, and then they'll go to final form. This is one of the first circumstances where they've actually said, because of the almost 1,000 comment letters, they wanted to re-expose the draft and give folks time to digest this. And as you can see, the effective date is going to be sometime in 2015. Again, sort of an unusual standard in that it's going to be issued in 2012, but then folks are going to have 3 years to adopt it. And I think the intent there is that it's going to be a very principles-based standard, not a lot of prescriptive rules, and as a result, they want to give folks a lot of leeway to read the final rule, understand how to apply it, and likely what will happen is some of the bigger companies are going to adopt this standard early, and then the later adopting companies can take a look by example at what the larger companies are doing and any interpretation that the SEC or some of the larger accounting firms need to put out there will already be on the books, so that by the time January 2015 rolls around, the simpler companies or those companies with less robust accounting staffs really have already seen some good examples of how to put this into action. So with that, I'm going to turn it over to Yolanda, and she's going to talk a little bit about the top issue that companies are facing in revenue recognition under the current rules.
Thanks, Matt. You know, it's interesting when you look at all the advancements in high-tech these days that companies still have the same issues they've had for years. And those issues are just struggling with how much time it takes to handle the revenue recognition process. Most of us operate with manual reports, maybe maintaining Excel spreadsheets, needing to update and adjust them each period. This process can be very time-consuming and not always accurate. In addition, we see finance departments needing to be flexible with their sales teams to be able to track the different types of schedules and make changes and the different types of sales and revenue recognition rules. And it's very hard to manage. So lastly, forecasting has been a top issue. Without maintaining, obviously, these complex spreadsheets, companies don't have an easy way to forecast future revenue. So as we know, time is limited, and we want to be spending our time efficiently. So what we hear that companies really need is easy access to key reports, future forecasting capabilities, and the ability to reduce revenue leakage.
Maybe you could expand on revenue leakage?
Sure. Revenue leakage is a term that is used when revenue isn't tracked correctly, thus is understated, typically resulting from unbilled or incorrect stated sales. An example might be when you're trying to tailor your sales to the customer's needs and having tiered pricing or incentives, discounts, and it's not always communicated accurately to the finance or operation teams, and therefore results in errors or unbilled revenue. So in addition, companies are obviously looking for a process or a system to handle revenue and deferred schedules automatically reconciling instead of having to do it as a manual process. We want streamlined processes so we have a faster sales close, and we want to reduce our potential for non-compliance or audit failure and the need to restate financial statements. One of the key elements to improving the existing issues is to remove the manual tasks often used in the revenue recognition process. And it's possible to get away from these time-consuming manual processes by using best-of-breed accounting software. And I'll highlight what functionality is available later in the presentation.
Great. So listen, we're going to do our first polling question, and remember you need to answer 75% of these questions to get your CPE. So with that, we want to take a look at time that you're spending. So during the revenue close, what do you spend the majority of your time on? So you're going to click A for compliance, such as your VSOE analysis, B for forecasting, C for accuracy, and D for simply building all these spreadsheets. Let's take a look at what folks are really spending their time on during this process. We're going to leave the poll open for a minute here so that you have time to answer. Okay, we can see that many of you have answered, so I'm going to actually close the poll in about 5 seconds. So we'll do a countdown here. 5, 4, 3, 2, 1. Great, we'll close the poll here. So we're going to take a look at the answer, and Yolanda, do you want to comment on the answer?
Sure. I think it's really interesting that accuracy was the highest scoring, and it's true. Without automated systems, tracking and accuracy is very, very hard to do, and people have to go back to those Excel spreadsheets and look at them over and over. So we see this in the industry all the time. So let's hand it over to Matt to go through some specific rules for revenue recognition under these new standards.
Thank you, Lana. Let's jump to the next page. So under the new standard, there is effectively a 5-step process to recognizing revenue. One of the core principles is that an entity should recognize revenue to depict the transfer of goods and services to customers equal to the consideration that you're going to receive in exchange for those services. So the first step of this model you see here is identifying the contract with the customer. And when you're looking at the contracts, the first thing you want to understand is, do you fall within the scope of this new revenue guidance? There are some specific exclusions under the new revenue standard for existing revenue principles under leases, insurance contracts, and other contractual rights and obligations that have specific revenue guidance like financial instruments, debt, derivatives, and the transfer and servicing of assets. Another thing that you will find under this new standard is there is a significant increase in the disclosure rules. As you read through the new standard, you see that it is more principles-based and there's much less prescriptive rules. And so again, I think as a result of this, in the way the standard is written, you're going to find a lot more interpretations that will need to be generated and the best practices of big companies that are going to be followed as an example. Okay, so step 2 is identifying the separate performance obligations in a contract. Again, you'll note that some of the wording in this new standard is significantly different than you may be used to under the old standards. Performance obligation I equate to what we defined as deliverables under the current revenue guidance for multiple element arrangements. And again, I think the reason that you see a different use of words and terms in this new standard is because it is meant to be so broadly encompassing. The boards are trying to create a framework that allows companies to identify what is distinct when looking at a contract, what is a unique deliverable. If you look at existing U.S. GAAP, there are 2 current methods that I'll put into 2 categories of recognizing revenue. The first would be multiple element arrangements where you are trying to separate each element into a distinct item and then recognize those elements separately. And the second general method is construction or percentage of completion, where you're taking a significant number of deliverables, combining them, and recognizing them ratably over some time horizon. So under this new revenue rule, the first step is to look at each of the distinct items and understand, does the entity sell them separately, and does that provide a benefit to the customer on a standalone basis. You have to look not just at the nature of the item, but also closely at the entire arrangement and understand, is it being delivered as one item that's integrated, and therefore in the eyes of the customer it's a single solution or deliverable. And if that's the case, then you step away from trying to recognize distinct elements. So let's expand a little on the approach to determine when an item is distinct. The board is not, with this new standard, the boards are not intending to significantly change the way that companies currently identify separate performance obligations. If you follow the framework, it's likely that you're going to arrive for multiple element arrangements at the same answer that you are now once you adopt this new standard. Again, step number one, take a look at the goods and services. Are they delivered in a highly integrated or bundled fashion, and are they customized? If the answer is yes, a good example there would be development of a software solution that's highly customized, then you need to account for that as a single performance obligation. But if not, if there's the ability to separate and it's not being sold, then you have to take a look at, are the goods and services sold separately by the vendor? If not, then you're back to the same answer, which is bundle everything together. Take a look at a different criteria. Does the customer benefit from the goods or services, and do they have other resources available, either internally or externally, that could allow them to finish the project? Again, a good example here would be if you're delivering a software solution and you're doing multiple components of integration. If the company receiving that could either use their own internal development team or go outside and hire somebody else easily to finish the project, then it's easier to separate the distinct criterias and recognize those elements as they're being delivered. Okay. So step number 3 is determining the transaction price. As you read through this page, the key word to focus on is total consideration. And the new standard gets into a concept of variable consideration. A good example there would be if you sell a good or a service and you're expecting to later provide a discount, a rebate, a refund, or perhaps there's a performance bonus attached to the item that you're delivering. Let's say you're developing software, it's going to take 6 months, and you've got a performance bonus that says if you develop this software and deliver it to the customer inside of 5 months, then you get a additional success fee. So in that circumstance, let's say the success fee is $100,000, total project cost or total revenue under the project is $500,000, so $600,000 worth of consideration. Under the old rules, you would just recognize the $500,000 ratably and the $100,000 would be deferred. Now, under this new method, you're supposed to either use a probability weighted average or the most likely amount. So if your company has experience in delivering these solutions and you say, hey, there's no way we're going to miss that 5-month target, then under the new rules you'd be allowed to ratably recognize that incremental $100,000 performance bonus over the period that you are delivering the solution. And again, the new rule and the way it's written allows for more judgment and flexibility in the recognition of revenue.
Great. So we're going to go on to our second polling question for the day. And the question is going to come up in a second, but it's a multiple choice answer. The new revenue standard will, A, replace all industry-specific revenue guidance, B, is intended to simplify revenue recognition, C, is a joint collaboration of the FASB and IASB, or D, all of the above. So please do take the time to vote. We are still holding the polling open so that everybody can have time. We're getting to the point of closing it in about 5 seconds. So we've got 5, 4, 3, 2, 1. We'll close the poll, and I'll turn it back over to Matt for your results.
Thank you, Lori. So 91% of you answered D, which is the correct answer. So it's good that everybody's awake and paying attention. The interesting thing on this question is item A, one of the answers was that it would replace all industry-specific revenue guidance. At the beginning of the presentation, I did walk through, and if you read through the standard, there are some specific items, again, that are going to be excluded, but this is a broad attempt to replace all of the existing guidance for software, construction-type contracts, and even all multiple element arrangement revenue guidance that is out there. So it is, again, a very broad standard. All right, so determining the transaction price. Interestingly enough, one of the concepts being introduced in this new standard is the time value of money. And so an example would be if you sign up for a multi-year contract and let's say you're not getting paid until years 2 and 3 in that contract, the new rules and the application of those rules will require you to take some of the revenue that you ordinarily would have recorded and put it below the line as interest expense, and then over time you're accreting interest expense and deferred revenue. And so what the impact that has is for long-term contracts, they are going to be less profitable in the early years because you're going to be pushing a portion of the revenue attributable to those arrangements into the latter years. This was an area of significant feedback in the first exposure draft. Many companies were saying, hey, if you are introducing the time value of concept to a revenue standard, then you also need to do it on the supply side, because many of the companies that have customers that pay them on extended payment terms similarly enter into similar arrangements with their suppliers, and there's no existing guidance out there that would lead them. So you're going to get sort of a distorted answer where you're pushing revenue into latter periods, but your expense is going to be more ratably recognized, and therefore the result is going to be in the early years, those long-term contracts are going to be less profitable. It doesn't have any net impact on the bottom line because it's just a movement of revenue to an interest component. But again, it may be distortive to revenue, so we'll see when they come out with the final standard. Again, I know this is a big point of feedback and comment. Even now, many of the constituents are objecting to this piece that was left in the original guidance. There is a practical expedient clause in there which effectively says if it's inside of 1 year, you do not need to apply any time value of money. The second concept in determining the transaction price that's new under this standard is the collectability. This is the gross amount you expect to earn, but what's interesting is historically companies have recorded bad debt as a selling, general, and administrative expense. Under the new rule, you record the amount as gross for revenue, and then immediately below the revenue line item, you're going to have a bad debt expense line item. So that bad debt expense that historically only impacted operating income is now going to negatively impact your gross margin. Okay. So this slide provides a flow chart of how to allocate value in the transaction when you've got multiple obligations. So in the example here, you've got A, B, and C, which represents 3 performance obligations of the contract. And again, I don't think I'm expecting everyone to take a look at this slide and immediately digest. Generally, the allocation is done on a relative selling price approach, which for those of you who have adopted the new multiple element revenue rules, it's very similar to those. The one distinction is that under the existing multiple element arrangements, there's a hierarchy of evidence that you must look at in determining what is your best estimate of price. You have to start with VSOE, third-party evidence, and then finally move to best estimate of selling price. This kind of jumps right ahead to best estimate of selling price and says you should be looking at observable prices if they're available, but if not, jump right into the estimation process. And similar to existing guidance, you could use a cost-plus approach. Take a look at another alternative would be the market assessment, where you look at what vendors selling similar projects or goods and services to you are selling. And another interesting aspect of this is that it reintroduces the concept of residual, where if you know the price of A and B, you're selling those in the market, then by default you can just allocate the remaining amount of transaction price to value C, or the deliverable for value C. which again is interesting. If you look at the software rules right now, they're so prescriptive they don't allow you to use either the residual or the reverse residual method. So it sort of reintroduces the flexibility to accomplish that.